second one, indicator that we want to talk about is called the MACD. A MACD is also in the similar category as moving averages, which means that they work best in trending environments, which means that in sideways environments, it's better to not even, it's still best to look at price and volume instead, as opposed to looking at your indicators, particularly moving averages and MACD. So MACD is best used in trending environments. It's a lagging indicator. Lagging indicators are best used in trending environments, but an effective momentum tool that uses a crossover system. Now, MACD looks complicated, but it's fairly simple. There are three components. The first two are the red line and the blue line that you see go up and go down here. It's called, the faster line is called the MACD line, which is the line on top, and it moves, it's the first one to cross below the slower line. And the blue line is called the signal line. Now, what that simply means is that, and by the way, your MACD is a derivative of your moving average, which means that it's a derivative of price. If you want to know the formula as to how MACD is computed, it's simply computed using price, which is precisely why it always falls behind price, behind your decision-making hierarchy, because you want to make your decisions based on the source as much as possible. So your MACD and signal line work simply, if they cross up, then it's a buy. If they cross down, then it's a sell. If you see here, once prices cross up, meaning your red line crosses above your blue line, then you have positive momentum. You have positive momentum in your stock as long as your red line is above the blue line. That momentum is essentially the distance between the red line and the blue line, and that is measured in these horizontal bars over here. Obviously, the higher the bar, the higher the momentum. You guys see that? And then the last one is the zero line. The zero line, you see this zero number over here? The zero line is your horizontal line over here. It's the horizontal line where the vertical bars emanate from, both going above and going below. If you see vertical bars going above, then that is your positive momentum. If your zero line, if your vertical bar is below the zero line, then that is obviously negative momentum. Here you can see that positive momentum is decreasing. Here you can see negative momentum is decreasing as well. So how that works, if we look at an example, is you want to be able to combine both signals, which means that you want to be able to buy when both lines, when the red line crosses above the blue line, while both of them are above the zero line. You guys follow? So you have here a cross up, which gives you the first of two buy signals, and then as prices go above the zero line, then you get both buying signals already, and that means that at this level over here, it gives you the buy signal. Now here's the question that's mostly asked. Why do you have to wait for both lines to go above the zero line? Why can't you just buy over here when the red line crosses above the blue line? Huwag mo na hintayin yung akyat dun sa zero line or sa horizontal line. Di kung ganun, nakabili ka dito. When both of your lines are above the zero line, it means prices are in an uptrend. If both of your lines, blue and red line, are below the zero line, it means you're in a downtrend. Which means that if you're going to use this signal to enter, this particular signal, obviously in hindsight, kita mo umakyat na. So tingin mo gusto mong bumili, di ba? However, there are a lot of times, 50% of the time, when you enter here, it could simply be a rally inside a bigger downtrend. Meaning a short-term up move inside a bigger down move. Which is precisely why you want to be able to wait for the cross-up and both lines going above the zero line to make sure, or to at least have a higher probability that you're buying a buying signal inside an uptrending environment. And MACD is typically a lagging indicator, which means that mas sigurista siya na indicator. It doesn't give you an early signal, but it gives you a signal when, I don't want to say 100%, but let's say 80-85% prices are already in a predetermined uptrend. So when you buy, you need to wait for both signals, but when you sell, you can simply use the cross down in your MACD to be able to sell using the short term. When you have a cross down in the MACD, it signifies that you are now entering a period of duration. Especially when you have a, let's say for example, you have a cross down over here, but it crosses down, but it stays above the zero line. You guys see that? It doesn't go below the zero line. It means that you have some sort of a duration happening inside an uptrend, which is precisely what we saw here. You have magnitude, duration, cross up again, magnitude, and you have some sort of duration, magnitude. Is that clear? Okay, so let me just show you how to use the MACD. So you click on MACD, click on create, and you'll see your MACD over here. You guys see that? So in the case of DNL, prices crossed up, but are both lines above the zero line? No, which means that it's not a buy signal altogether. But even if you take a look at the context, what did we say? MACD is best used in trending environments. In this case, you're not inside an uptrend, you're in a generally sideways to downward movement. In this particular case, I'd still prefer to use my support resistance lines and to be able to use my bounce of support and breakout of resistance as the basis for my decisions, as opposed to using indicators in market environments where prices are generally in a sideways or in a corrective fashion.